Greetings, family. Thank you for joining us here at Living Equity, where we're going to go over a few things regarding um, whole life participating products and a little bit of IUL, doing a little bit of comparison here to clear some of the confusion. I'm not going to go into extreme details, but I should give you enough where you can feel a little bit more confident moving forward and making a decision, a financial decision, not using the herd mentality that you may have heard me talk about before, but using a sound decision when you make a purchase. All right, so let's go over a few things here. First and foremost, when it comes to money, we have to understand that number one, we want to protect our principal. Two, we want to have a product that we can take advantage of when regards regarding taxes. So that's either reduce taxes or simply completely avoid it. Right? For the principal, of course, what we want to protect our principal, and we want to protect it from high risk products. Okay. Number three, inflation. We want to have a product that hedges against inflation. Okay. Uh, so as prices rises, we want products as interest rates rise, our rises as well with those interest rates. We want a product that's going to be very minimum in fees here. Okay. Honestly, you guys, 2% every year can destroy your portfolio. Believe it or not, it definitely can destroy your entire portfolio. Um, and we're going to get into fees in a second on some of these insurance products. Five, the bonus here, passive income. Okay. We want a product that either produces us a passive income, right? And the great thing is insurance, in particular, whole life participating policies provides uh, basically everything we need here. Now, it's not deemed as income, but it's some form of a passive form of payment that you're getting every year, that you have the potential to get every year. But now, we can't guarantee that. Um, but we can tell you uh, that you have that potential. Now, let's get to it. The next thing is when it comes to IULs and how IULs work when it comes to growth. All right. So we have IULs, and they typically give you what is called a cap, or they give you a participation rate, give you another one called a spread. But we're gonna go over cap and par for short for participation. Thing about IUL is your money's not into the market; it's tied to an index like the S&P 500, the Barclays, um, Nasdaq, right? Some of these things you may have heard of already. The 500 consisting of the 500 major companies. So they'll say, hey, look, your money will be tied to the P500, and you have a cap, meaning the ceiling, which is the most you can make with this company, maybe 12% or sometimes 13%, right? And it can be even lower than that. But let's just break these numbers. Let's say 12% or 13%. Let's say 13. Let's stick with 13. And if the S&P 500 that year, if it did, say, 14%, what do you think you're going to get? You're going to get 13% because your cap, the most you can make, is 13. You cannot participate in anything higher than that. Did 15, you're going to get 13, right? But what happens if the market does 12%? Well, you're going to get that 12%. The thing everyone love about IUL, I'm sure, is that it has something called a floor. Zero is your hero. So meaning if the S&P 500 is terrible one year, maybe -3%, you're going to get zero to 1% guaranteed if the market did somehow do terrible that year. It'll get 0 to 1%. And this applies on the cap side as well as our side. There's really no difference. The difference between a cap and a par might be fees associated with which one you use. But also, with par, they're basically saying here, we'll allow you to participate in whatever the market does. So that means there is no cap on what you can make. Unlike cap, you have a ceiling. No cap, there's no ceiling at all. Okay, you can do what the market does. And I like no cap because that's a slang, which is also financial slang. So there's no cap. No cap. But 145% participation in the S&P. So the S&P did say 10% that year. And let's just say in that cash value product for 2 years, you've grown, say, 100,000 in cash value. So year 21, the market did 10%, which gives you 10,000 in returns. And I'm not the greatest mathematician ever, you guys. So please excuse if I don't do the math you like it to be done or how you do it. This is the way my brain works here for right now. It's pretty late on my end too. So, 10,000. And I typically will multiply that by 145%. And that's going to give me $14,500 that I made that year, which is an additional $4,000 on that growth because that additional 45% helped me get that 4.5. I'm already have no cap, meaning I could participate in 100% of what the market already does, plus an additional 45%, right? That's how you get 145. And that's how I got my math there. But the bad thing about the IULs that I'll tell you about is one, that last number 4. What was number 4? Fees, fees, fees. These products can have a spread or a fee that adjusts at their own discretion, by the way, of 4 to 6% spreads, meaning this is what you have to pay. Okay. Even to where there's a no gain market, you still have to pay a fee. So you're not losing due to the market. Yes, you're not, but you will lose due to fees if the market so happens to stay down. This product is only 27 years old, by the way. Uh, Introduced in 1997 from its predecessor, ULs, in the 1980s. But only less than 30 years tested. I haven't really been tested with time. It's like a lot of new financial products out there. Uh, so this is one of the cons of an IUL is the high fees, the costs. And then by the time, say, you're in the 15 of having this product, insurance cost increase. Okay. So you'll have less money going towards the cash value bucket, which should be growing. So your money typically like this. This is an example. Okay, this is not, excuse me, I didn't even put year month. So this is $200 a month you're paying. We could say this, yeah. So we're gonna say $200 a month. It's $2,400 a year, and typically you have 2 buckets. Okay, you have a death benefit bucket, DB for short. You have a cash value bucket. And typically every year or every month, a portion of each payment of the premium is going towards the cash value and the death benefit. So just an example, 150 may go towards the death benefit cost that year, and $50 that year will go towards the cash value, gaining interest of that cap or that spread or that par, excuse me, you're connected to. And every year it increases, right? But unfortunately, by the time year 10 to 15, this kind of reverses itself and it decreases because now more of your dollars is going towards death benefit versus it should be going towards your cash value. So this has what is called, in essence, a renewable term built in IUL. And if you had term policies before, every year the cost of insurance increased because you got older. Not your death benefit, but the cost of insurance increased every year. Maybe be a little bit dollars or whatever, but it increased. So with IUL, that's built in, so your premium doesn't necessarily increase, but you'll be forced to put more in the premium so you can have more go towards the cash value. Or most of your, if you don't, most of your premium will eventually be going towards your benefit more than the cash value. So that's one of another con of the IUL. All right. Now, if I were to get an IUL, I will compare it to a 401k IRA, a real retirement product. Because IULs do avoid taxes. IUL do allow you to leverage your cash with market like gains and take full advantage of the upside of the market without participating in that downside. It is higher in fees. That's one of the chances you take for being able to invest in that type of product. You will incur more of the risk than the insurance company does. Um, it is a young product, so it really hasn't been tested. That can be good and bad. And if I were to compare it, it would be a tier two product, which means it's not my tier one product, which whole life participating, in my strong opinion, will be a tier one product. I would not use this product as a debt eliminator or a recapture reallocate product for debt. It's great for children. I don't really recommend it for the upper age adults at all. It's great for children for the fact that children have more time to deal with the ups and downs of the market than adults who are in a position to where they're trying to position themselves to retire, uh, uh, if not sooner, comfortably without having a risk of their money. It does not pay you dividends like whole life participating policies at all. And we're going to get into that. How does whole life work and what does that look like for you as a potential client? I don't even like to call you a client, but uh, someone I would love to financially advocate for in the future. We will be following up with you, doing financial checkups to ensure that you're using your product. We will guide you on how to use your product, and we will, see what you're getting it for first and foremost, so we can better aid and assist you in using that product for that purpose. So let's move forward.